Is there a way you can retire without the fear of running out of money? The 4% rule is one of the most talked about rules in the world of financial independence. It's research based and well tested through various different studies. And today we'll discuss what this rule is and if this is something you can start implementing on your own journey towards financial independence. A whole range of different scenarios were conducted to find out what the ideal withdrawal percentage was from an investment portfolio. That percentage had to be a number that meant you would never run out of money and be able to maintain you a reasonable lifestyle during your retirement years. The study conducted applied the following parameters. It tested that over a 30-year period, what withdrawal percentage would you need so that you never ran out of money? Percentages were applied from 3% to 12% to various different portfolios that had a different mix of stocks and bonds. And the results showed that on a portfolio with an allocation of 50% stocks and 50% bonds and a withdrawal rate of 4% every year allowed the portfolio to remain intact to last you a 30-year retirement. The studies showed that there was an extremely low chance you'd ever run out of money by having this withdrawal rate, hence the 4% rule. Now, other factors to be noted, of course, are the actual portfolio size and how much money we invest during our lifetimes. Let's take an example so we have an idea of how this can actually be applied. Let's say in retirement you want to live off £40,000 a year. To maintain that spending, you need a £1 million portfolio in retirement. This means in the first year you can withdraw 4% of that, so £40,000. You would do this every single year, and the assumption that's being made was that as long as your portfolio was made up of 50% stocks and 50% bonds, even in the worst forming stretches of the stock market history, you would never run out of money. With this 4% rule, it basically wants you to invest while you're living off your cash. So ideally the investing returns are actually accumulating while you're still withdrawing from that balance. The big assumption that's being made about these studies was about retiring, which was that retirement will last 30 years. And back in the 80s and the 90s, this may have been true. You might be in your 60s and you just need your money to last until you're about 90 years old. However, in more recent times, people want to retire earlier and life expectancies are getting a lot longer. So you actually need to plan for maybe a 35 or 40 years. Or some people even want to plan for 50 years of retirement. If you want to dive a bit deeper into the actual stats, we can take a look at this chart. It basically shows you a percentage of success of not running out of money, depending on how long you need the money for and your asset allocation. The top row shows the asset allocation split, with 100/0 being a portfolio of 100% stocks and 0% bonds on the very left, and then 50/50 is 50% stocks and 50% bonds. On the very right, you can see a portfolio split of 0% stocks and 100% bonds. In the table results, we can see the success percentages. So 100%, which is everything in the green, would mean that there is no historical scenario that shows you would ever run out of money for the given time period, and the asset allocation. So if you had a portfolio allocation of 50/50 in stocks and bonds, and you withdrew 4% a year of your balance every year for 15 years, there was no back-tested scenario that said you'd ever run out of money. Now, if you look towards the end of the first column, you can see how the percentages are around the 50% mark. This means that according to all the historical scenarios, you have an approximate 50% chance of running out of money before that time period of 70 years is up. If you had a 0% stock and 100% bond allocation, your portfolio would actually be fine up to year 25, where it still has a 99.92% success of never running out of money at a 4% withdrawal rate. But as you can see, after 45 years, there's virtually no chance you still have any money left based on that historical data. As you can see, most of the successful allocations and percentages are in the middle. A portfolio roughly divided between stocks and bonds had percentages greater than 90 to 92%. So the takeaway of this chart and the 4% rule is that if we're looking to retire and have our money last 30 years, we should probably be in a stock and bond portfolio split of 50/50. Now recently though, the 4% rule has been criticized. The original founder of the 4% rule has even updated his guidelines, saying that retirees should withdraw up to 4.5 or 5% of their retirement balance every single year. And he said that because he saw that many retirees were actually dying before spending their savings. But should this mean you need to adjust your withdrawal rate? Having a higher withdrawal rate may mean you run the risk of running out of money. And I'm sure most people would want to be on the more cautious side to avoid something like this from ever happening. If you are feeling a little bit more on the conservative side, you can lower that to 3.5 or maybe 3% every single year. However, you're going to need a lot more money to retire because when you withdraw less, you're going to need a higher balance to start with. Now, if you want to retire early, should you still use a 4% rule or maybe a 3% rule? Okay, so the earlier you want to retire, the longer your time horizon is going to be. Figuring out your time horizon is a very personal process when it comes to retiring. Now, the earlier you want to retire, the more you actually can't use a 4% rule. The 4% rule by definition is for a 30-year time horizon for retirement. You shouldn't use it for 50 years or longer. Now, let's pretend you want your money to last 40 or 50 years. When you extend the length of your retirement, there's is a wider margin for error when it comes to your retirement portfolio. By calculating our spend, we can figure out exactly how much money we need and then work out steps to get there. So retirement spending is usually determined by what your pre-retirement income is and what your lifestyle is like. If you're used to having a more luxury lifestyle and living on a higher salary, you're going to need a lot more money compared to someone who has a much more modest lifestyle. Most people tend to try and maintain their standard of living, but there is an 80% rule that can provide some guidance on how much you can afford in retirement. And it basically states that whatever you're making on an annual basis, you're probably going to plan to spend 80% of that in retirement. So if your salary is 100,000 a year before retiring, plan on spending 80,000 pounds of that in retirement every year. But again, this depends on your income. People that make less than this will probably have to stick to this 80% rule. But if you make a lot more than 100k per year, maybe 200 or 300,000, you don't really need to stick to this 80% rule because that would be a lot of expenses in retirement. For most people, we should stick in the range of 55 to 80%. Now, if you want to remain very active in retirement years and you want to travel the world and do more fun experiences, then you'll need a lot more money than someone who just wants to have a more simple, mellow retirement. It's also important to note that our spending does change. The average spending on food, entertainment and transportation goes down as we age. Annual housing expenses also tend to decrease as we enter retirement because people start to downsize or move to cheaper cost of living areas. Or it could just be that's around about the time that people pay off their mortgages. So the only expense for housing that most retirees have in retirement is insurance and taxes. The main expense that does go up is healthcare, as you can imagine. You can expect to spend about 15% of your retirement on expenses in healthcare alone. So that's the 4% rule. I hope you found this helpful and see you next time.